Hey folks, David Frost, my strategic forecaster, here for another episode of Common Sense Market Analysis. Today is Wednesday, February 24, 2016. Interesting day today, and we have a lot to talk about because I have a pretty good handle on where the market's going from here, what's going to happen next, and following that. So let's get right into it. Let's do a quick recap from yesterday. So yesterday we had the down day, and I put in this purple line yesterday saying that the market was probably going to go down and test that line, which is at 190.75. We did that and some more. We went into the 200 period moving average. We went into the 20 period moving average and bounced off that, and then we had a nice reversal day today. Not on tremendous volume, but on more volume than we've been having lately, and that's important. So I was able to run some calculations based on the range of today, the volume, the propulsion off the low today, and a number of other things. And I came up with an additional upside target and also came up with what I'm going to call a confirmation that the market is still going higher, and it's going higher significantly compared to where we've been over the near term. Okay, so what does all that mean? This is new information, and it's good information, right? So a couple of days ago, we came up short of my 195.03, and then we started down, and it looked like that was weakness in the market. But what happened was we're still in the midst of this final leg of the ABC corrective pattern. So let's review what that is, and then we'll talk about where we go from here. So we had the A move off the low, here was the B leg, and here's the C. Now, we could have satisfied the C leg with the close the other day since it was surpassed from the A leg, right? So here's A. We have the B leg down, okay? And then the C leg here, this could have satisfied the need to close above the A leg, but I don't think that's it. I think this was a fake out. I think that we've got much higher prices coming. In fact, my calculations today came up with another additional price target, and that comes in at 198.50. That's the purple line up here. So we're done with this line. We satisfied that today. We don't need that any longer. Okay, and by the way, just so everybody's aware, and so that you understand how the market works, and I know that most of you and all of you do understand how the market works if you've been around a while and been listening to me. Okay, the way the market works, everything was under normal market conditions based on today's movement. Why do I say that? If you take the low to the high from the other day, okay, the high from Monday, all this was a 382 retrace, all right? So just for kicks, let's do it real quick. Dirty math, okay? Low to high, okay? Where were we? 382 retrace, pierced through it, and catapulted higher. Now, it's not to say that the market couldn't go down and satisfy a 50 or a 618 retrace. That certainly could have happened. But the fact that we bounced so meaningfully off that level, and it was the 20-period moving average, and it was on more volume than we've had lately, but not tremendous volume. So that's the one missing link. But there's a couple of other things that were going on that all play into this equation. So what I've come up with is 198.50. That's a mathematical calculation that I came up with this afternoon that has not surfaced before. We had 197.56 and we had 201.10. Now we've got 198.50. So what does that mean? What that means to me is that there's a less likelihood that this number, I'm going to take it out. This is the number, okay? I did this 6 ways till Sunday, and this number was more meaningful. So what we've got is we're going to go back to 195 this week, whether it's tomorrow or Friday, okay? Either way, we're going back to 195 this week, all right? That's almost a fait accompli in my mind. Then that's going to suck in all the bulls back into the market, and the market's going to propel up to 198.50 on the spider. That's my take. That's what I see happening, and or higher. But that's the next target that I see happening after we resatisfy the 195.03. Why do I use the term resatisfy? Because we never really got to that target. Remember, Monday, we got a high of 194.95. That never satisfied the 195.03 target. I like when the targets get satisfied. When they don't, it puts the market in what I call an unresolved position. And I don't like it there. It never is a good thing when the market's in an unresolved position. So first we're going to go hit the 195.03 or higher, and we're going to continue going, in my opinion, to 198.50, give or take. And whether we go higher all the way up to the 201 or not remains to be seen. But that's at the point in when we're going to start looking for the market to begin signs of making the next turn down. That will have completed. The 198.50 or higher will complete the C leg of this rally. And that will put the market in a resolved bearish or bullish counter trend move in a larger term bearish corrective pattern. Let me say it more simply. This is a corrective bullish rally in a bear market that will most likely conclude in this zone right here. And let's use this C for conclusion. Okay? So as it stands right now, I have a pretty high level of confidence that that's what's taking place. All right? And this could all conclude in the next week or less. It can conclude sometime between, the end of this week and at the end of next week. I don't think we get up to the 198.50 this week, but I certainly believe that we'll get back to the 195 tomorrow or Friday. All right, so that's my take on where we are. Now, the IWM was interesting today because the IWM, and if you're intraday market watchers or traders or both, you need to pay attention to the IWM. Here's a 10-minute chart. The IWM was the stronger index throughout the day. It was leading the market up. It was the tell. It was the canary in the coal mine. Up move, wedge pullback pattern, bullish pullback pattern, another up move, pullback pattern, another up move, pullback pattern, another up move, minor pullback, another up move. This was doing this all day long. This was the leading index, okay? See this channel, this upward channel, all right? When did the up move in the IWM really start? It started, okay, at 10:40 in the morning, as did the spiders, okay? 10:40 in the morning, same move. But the IWM, you see this, how the spiders went sideways, okay, for a period of time in here, okay? Now watch the IWM in the same time period, around noon to, let's say 2 o'clock. Now, if I take this off and I look at the IWM and we look at noon to 2 o'clock, okay, you see this? It was a stronger market. This started higher, okay, less of a pullback between noon and 2 o'clock, all right, but it went higher right before that. So if you overlay the chart, and I'm not going to do it right now, but if you overlay the spider and the IWM, you can see where the IWM was the stronger index. That was telling you the market was stronger and was leading. The IWM was leading the market on the upside today. And that was the tell. That was the canary in the coal mine. Okay? That's not the chart I wanted. Okay. So same thing goes for the IWM. We're going to go satisfy the 102.5, and then we can get up to 104.61 and or higher. Okay, that is possible. Let's go over to the transports. The transports came back into the 50-period moving average and catapulted higher today. Okay, they finished down slightly by $34 or 34 points, 0.5%. But again, as long as the broader market is in an upswing, there's a chance that these transports get up to the 76.10 area, this red line here. That's going to be a ton of resistance. So this is still in a bullish formation, bullish pattern. This is still in an uptrend. There's nothing wrong with the transports. Still in a bullish position. Let's go look at gold real quick. Now, interesting, right? When the market was selling off today, and this is that correlation we've been discussing, the negative correlation with the stock market and gold. Let me go over to the April contract. This is the continuous contract. So the negative correlation, the inverse correlation with the stock market and gold. Let's go over to the 10-minute chart real quick. Okay, and you can see here, gold was headed up, and when the market turned, gold started to sell off. And when gold started to sell off, the market was going higher. Okay, so if you go back to the daily chart, you can see here that this could be deemed as a topping tail, okay, an interim topping tail in gold on volume, right? Decent volume. Average daily volume on this contract is 88,000 contracts in the gold April futures contract. Today we had 259,000 contracts. Okay, that's a big day. That's a reversal signal, okay? The stock market reversed today and gold reversed in the other direction. Now, is gold in trouble going way lower? No. No, this is still formulating a bullish pattern, okay? So what we have here is we had the up move, okay? Right? We had the up move from here all the way back from down here, the up move, and now we're just consolidating, okay? Tried to break out today and failed. Didn't work. Broke out, failed, went reversed. Okay, so there's nothing wrong with continuing the consolidation pattern. I'm still in the camp that we can get down to $1,181. And if the market, the stock market, goes all the way up to the numbers that I think they're going, you're probably going to find gold down at 1181 or lower. Okay, that doesn't mean it's not going higher later. Okay, when the stock market corrects again, you're likely to see gold move higher. Silver, same routine. Same chart, same routine, same event today. Reversal day, but it's still in a bullish consolidation pattern. Up move, wedge pattern. Sideways consolidation, bullish wedge pattern, building energy for another move higher. Same as gold. No different in silver and gold. Okay? The chart patterns look very, very similar. All right, let's go over to the bond market. Bond market, again, same routine I discussed last night. Nothing's really changed. Okay, the bond market started to spike higher when the stock market was lower. The bond market pulled back when the stock market went higher. So right now we do have intact an inverse correlation between bonds and stocks, an inverse correlation between gold and stocks. I know I skipped oil. I'll come back to that in a second. I just realized that. But let's finish up bonds first. And so this certainly, in my mind, has lower prices coming if the stock market goes on the rise, and I believe it is. So not going to be out of the ordinary or out of the picture for the bond market to come back down and retest the breakout area, which is below 164. Okay, so that'll still leave it in a bullish position. It'll be bullish consolidation, right? See this? It'll be bullish consolidation. As long as we stay up in this area, okay, as long as really, here's really the breakout point. As long as we really stay up here, this is still in a bullish position. Now let me show it to you another way, okay? If we draw a Fibonacci retracement from recent low to the recent high, okay, it's a rough draft over here. Well, let me fix it. So the high was 170.26. Well, that was pretty close. Just didn't look like it on a chart. Okay? And the low is close enough. So right here, it's not out of the possibility, not out of the realm of possibility to come back down to the 382. And just so happens that what is that? That coincides with this breakout, right? Little tiny bullish consolidation for a couple of 3 days, and then we broke out. Okay, here we go again. The 50% retracement is another breakout point. So we consolidated here for a much longer period of time, right? We had the up move, consolidated sideways, and then we had another up move. This is could come back down to retest one of those two areas and still maintain in a bullish position because it will just have been a normal garden variety retracement, fib retracement, 382 or 50% retrace, even down to the 618, still leaves it, the bond market that is, in a bullish position. Okay, gold is very similar. You can almost overlay this with gold. Same discussion, same fib retraces, same story. You can almost overlay it the same. Now we're going to go back to oil, but real quick, I want to make mention of something. So we have the open SDS position, and I know I've gotten a couple of questions. If the market's going higher, why am I holding it? I'm holding it because the market's going to go higher for another week or so, okay? That's not my concern. I'll add to it, I'll double down, but I'm also going to add short positions, and that's what I was discussing yesterday. I was waiting for the market to go higher to add short positions, okay? And it pulled back yesterday and didn't give me that chance for the numbers I was looking at and the price levels on some stocks I was looking at. So what my intention is to do exactly that. So over the next several trading days, look for more positions to come out on the short side. And there's a chance, based on tomorrow's action, if we get a decent enough pullback, or if we get some kind of stall out, unless I feel like the numbers are not going to be reached on the upside, we may actually play some things on the long side. I'll put out some alerts to that effect too. Because the fact that there may be significantly higher prices coming in the S&P, we may want to take advantage of both sides of the tape at this stage of the game, even if it's for a couple of days on the upside, and then let the market turn and we'll play it back down the other way. Done it before, we'll do it again. Okay, let me go over to Crude. And that's not Crude, this is Crude. And we had a nice reversal on Crude. Okay, and I know the discussion all over CNBC today was the market reversed because Crude reversed. That's fine. Whatever the reason becomes doesn't really matter. I told you last night that, you could make a case for this was a bullish pattern, right? But it's not something that I'm willing to trade, right? You can make a case that's a bullish pattern and, just going sideways inside the up move. And that seems to be the case. That's fine. Let it go higher. I'm not interested, continuing to not be interested, to playing oil on the long side. I'm interested to play oil on the short side if we get up to my price targets, 36 and a quarter, 37 and a quarter, in that neighborhood. These are the mathematical numbers that I've worked out. Well, this one is the pivot high, the 36.28. This is the pivot high that was translated over from the prior pivot high from the March contract that we had a good target on the short side when the market was going up. We hit that level almost to the penny. I think it was 34.75 if I remember correctly, and translated over to the April contract, that comes out to 36.28. But the other number I'm interested in is 37.39, in that neighborhood. That's the mathematical number, but it also happens to be this pivot low. And when you see that and comes together with a mathematical calculation that I did, that tells me that this price level is important on the chart. Okay, it should not be discounted, should not be ignored. So I'm interested to let oil rise, let all the bulls jump on board, let the shorts cover, let the rising tide lift all boats. Let the tide go forward. Let it rise with everything else. If that's going to happen, I'll be happy to jump on the short side and take the ride down when they open the trap door back up. I'm happy to do that, but I'm not willing to play it on the long side. It's just the probabilities aren't in my favor. The swings intraday are too wide. It's not necessary to put that kind of capital at risk when I know that the longer term outlook is for lower prices. I don't need to time oil to the upside to try and catch a few dollars on the upside of a rally. It's not, the probabilities are just not in our favor. That's what I'll say. It's most likely going to go higher, could go higher, should go higher, all of the above. But I'm not willing to do that, to wake up one morning and find it down 6% or 8% or whatever it is. Not interested, okay? The odds are not in my favor. They're not in your favor. Okay, what did we leave out? We left out the dollar. The dollar was flat today, didn't do much. And you can see here, had a little bit of a wide-ranging day up and down into the 200-period moving average, spiked up, almost hit the 50-period moving average that we talked about last night, came up short. But again, this is making a potentially another bullish consolidation pattern, but this one will need more time, okay? And it may pull back farther. So I would like to, see it come back closer to the low of this green candle here, and then that would be, good for an up move. And we may see that if the market rises, we may see the dollar pull back simultaneously for the next several trading sessions. So that's where we stand. So I think I've talked about everything I intended to. Hopefully it's helpful. Got any questions, shoot me an email. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.